It seems wherever you look these days, people are stuck between a rock and a hard place, which has got the Fed, businesses, and certainly even most investors feeling the squeeze. This week we talk about how to endure the squeeze without getting crushed. So this week brought the much anticipated Fed announcement, and much like a blockbuster movie that disappoints, everybody kind of left unhappy. For those who were hoping or thinking that the Fed should raise rates, given some of the most recent inflationary data, they've left disappointed. For those hoping that it wouldn't just be a pause, but a signaling to the end of this rate hiking campaign, they're also disappointed. And trying to shoot that middle is probably what the Fed was after. The decision is a little bit surprising, though, given that they not only hiked in July, but signaled they'd be hiking in September. And in the interim has really been a bunch of data that was quite hawkish, meaning inflationary. You had PPI double, you had oil surge, you had unemployment hit even new lows, retail sales continue to hold up strong. And so again, there's a lot of reasons in many people's mind to see the Fed hike one more time, particularly on that oil front, to hopefully put that death knell into inflation. They didn't. That leads many, including us, to believe they're not only gonna have to come back once, but maybe come back more often. But in any case, and this was also indicated by the dot plot, that they're not going to be able to cut rates as aggressively in 2024 as they had previously hoped. They thought the last plot was that they would be maybe down to 4.6 by the end of 2024. The revised plot has them ending 2024 at 5.1. Again, just speculation on the part of the Fed. How this plays out will be really interesting because, again, one of the biggest outside of employment sources of inflation is oil. Those prices have been hitting recent highs. And this action by the Fed, which is dovish-ish, again, could put a further tailwind behind oil prices, and much like we saw in pockets of Europe this year, lead to a resurgence in inflation overall. So stay tuned on that. Where does this have everyone, though? Feeling the squeeze. So the Fed, again, they're caught between oil prices and trying to engineer the never-done-before soft landing. It's also got investors, I think, feeling the squeeze, especially for those who are diversified amongst equities, diversified amongst asset classes. Most things haven't been working this year out of the so-called Magnificent Seven. And as we were talking to one manager this week, they talked about, it isn't price or absolute price levels that get people in danger, i.e. Any asset class hits a price that is going to force someone's hand. It's time. And what they mean by that is patience, discipline. We start to feel this squeeze. Our investments they're not doing anything, or maybe they're even up against a little tailwind, or we see something doing so well, and we're gonna go chase that and leave where we're at. That's a quick way to get crushed, to abandon that plan, to abandon that portfolio allocation. The squeeze, whether that's from volatility, whether that's from having to fight back the fears of, or the threats of greed within ourselves, and that chasing of momentum is, again, part of the price you've got to pay to be an investor, par for the course. It's where people abandon their discipline that, again, they get into trouble. With that diversified, what are some of the asset classes where people are feeling the squeeze? Well, if you've been holding bonds for many years, you're really feeling the squeeze. Thank goodness we don't have to deal with that. But for people who are building those positions, which we've been saying again with discussions with your advisor, of course, may be appropriate for a lot of people, there's a lot of reasons to think that might be paying off soon. Bob Michael of JP Morgan's been out recently sounding the bell that he thinks things are attractive at this point. One of the big reasons for that is that inverted yield curve, what that means to recessions. Similarly, this week out came AllianceBernstein saying they think the Fed's gonna have to cut 4 times to get the economy back on track at some point in 2024. What they're not saying, but is clearly implied, is that probably means some real economic turbulence. So that's something to keep in the back of your mind with respect to your risk allocations, not for diversified investors, but for those who are overweighted into stocks or maybe solely weighted into equities or a small basket of stocks. that says, again, this is not the time to abandon that broad base. There's too many unknowns, too many rocks and hard places to try to navigate right now to try to make a big bet or take a big swing. The chart, which Matt's gonna put up over my face as we speak, is a great chart from AMG showing again when this yield curve's inverted, short-term rates get higher than long-term rates. A recession is usually not far between. This chart indicates our favorite way of looking at that, which is 10 years versus 3 months. And what it shows you is once that happens, a recession is usually not too far away. The average, skewed a little bit by the 1962 example, is close to 600 days. But if you look at that chart, you'll see a lot of days somewhere in the range of 300 to 500 days. We're a little over 300 right now, which means whether it's Bob Michael, AllianceBernstein, other famed managers, there's a reason a lot of people are saying, hey, look, don't get too aggressive right now, maintain your diversification, maintain your discipline, and take a look at a lot of those asset classes that have been beaten up. Yes, they're out of favor, but again, bottoms, buying low, which everyone knows how to parrot, is not a point, it's a process. And that process can often take a little bit of time, to harken back to the manager's comment, to play out. So what might be the catalyst for these cuts, for this turbulence, outside of maybe difficult to understand data point in the yield curve? Quite simply, interest rates, consumer spending. If you look at rates right now, by design, the Fed's been hiking rates to slow activity down. You've got mortgages, certainly multi-year highs right now. Quick Google searches on banks or businesses will show you that they're feeling the squeeze in terms of interest rates. And so that, coupled with the chart that Matt's gonna put up over my face again, showing consumer spending, this chart from Apollo, shows that people at the same time things are getting more expensive, all that stimulus money from COVID finally looks to be coming to an end. So this is at least what people are watching, they're looking for. Still a big contingent in the soft landing camp, but for those who say a soft landing is just the thing that happens before the hard landing, these are the kinds of things they're looking for. So again, feeling the squeeze, you're not alone. Everybody's feeling the squeeze these days. Again, the way you go from feeling the squeeze to getting crushed is oftentimes making those moves, not just letting it pass, giving up on that discipline, that diversification. That's what's going to get you crushed. So stay the course. We'll talk to you soon.